If you're serious about building wealth, there's one decision that matters more than almost anything else you'll do as an investor: which funds you actually hold for the next 30 years. And with thousands of ETFs out there, all claiming to be the best, how do you actually know which five are worth holding forever without slowly bleeding your returns away in fees and constant second guessing? Let me ask you something. If the market crashed tomorrow and stayed messy for the next 3 years, would your portfolio still make sense? Most people freeze at that question because their entire strategy depends on constant tinkering, chasing whatever's hot, panic selling whatever's down. But there's a much simpler way to invest, one where you build it once, correctly, and it just runs quietly in the background for decades. Here's how I want you to picture it. Think of your portfolio like a house. You need a foundation, or the whole thing collapses. You need walls that widen your protection beyond just your own street. You need a room that pays your bills even when nothing else is moving. And you need a floor underneath all of it that stops you from panicking the moment a storm hits. Most beginners try to decorate the living room before they've even poured the concrete, and then wonder why everything falls apart the first time the market gets rough. Today, we're building this house in the right order. By the end of this video, you'll know exactly what 5 things belong in a portfolio built to be held forever, what each one does, what it costs, and why it's there. Let's build it. Piece 1. Your foundation. VTI, or an S&P 500 fund like VOO. This is the layer everything else sits on top of. An S&P 500 fund holds the 500 largest publicly traded companies in America, the names everyone already knows across tech, healthcare, banking, energy, retail. VTI goes one step further, tracking the entire U.S. market, roughly 3,500 companies, which includes those same 500 giants plus a layer of mid-cap and small-cap companies underneath them. Historically, the two have delivered very similar long-term returns, somewhere around the high single digits to low double digits annualized. Over any given year, one might edge out the other, but over decades, they tend to converge. The expense ratio on either one sits around 0.03%, roughly 30 cents a year for every $1,000 invested. This is the layer you hold for 5, 10, 20 plus years, not something you trade in and out of. Piece 2. Your walls, a total world fund like VT. This is where most investors quietly sabotage themselves without realizing it. They build an entire portfolio of US companies and call it diversified. And in a narrow sense, sure, but that's a bit like saying you've tried every cuisine on Earth when you've only ever eaten within walking distance of your house. The rest of the world exists, and it matters. VT gives you the entire global stock market in one single fund. Thousands of companies, split roughly 60-40 between the US and international markets, covering developed and emerging economies alike. Here's why this layer earns its place even though the US has outperformed internationally in recent years. No single market wins forever. Economic leadership rotates over long stretches of history, and there have been entire decades where international markets meaningfully outperformed the US. Holding this layer means you're already positioned for whenever that rotation happens again, instead of scrambling to catch up after the fact. And the expense ratio here is still remarkably low, around 0.06%, with the fund rebalancing its regional weighting automatically, no manual adjusting required. Piece 3. Your income room, a dividend-focused fund like SCHD. This is the layer that pays you along the way, not just decades from now. Funds like this typically hold a basket of high-quality, established companies with long track records of paying and consistently growing their dividends. Keyword: growing. These aren't the flashy, headline-grabbing names. They're steady, reliable businesses that have kept paying shareholders through recessions, through downturns, through every kind of market chaos. A fund like this typically yields somewhere around 3 to 3.5%. That means real cash landing in your account regularly, which you can either take as income or automatically reinvest to compound faster over time. The expense ratio tends to run around 0.06% as well, cheap given what you're getting. Piece 4. Your floor, a short-term Treasury fund like SGV. This is the layer that keeps you from doing something stupid when the market gets scary. Most people either let cash sit dead in a checking account earning nothing, or they hold no cash reserve at all and end up panic selling their investments the moment something goes wrong. This layer solves both problems. Funds like this hold ultra-short-term U.S. government debt, Treasury bills maturing in 3 months or less, making them about as close to risk-free as investing gets, while still paying you something meaningful, often in the 3 to 4% range. And in many cases, the interest is exempt from state and local income tax, which quietly makes the after-tax return even better than it looks on paper. This is where you park money you might need soon, without it losing ground to inflation while it waits. Piece 5 isn't a ticker symbol, it's you. I know that sounds like a cliché, but stay with me. None of the first 4 pieces matter if there's no engine behind them consistently funding the whole structure. Before Investa became what it is today, it was years of scripts nobody watched, blog posts nobody read, and content built late at night around a day job. The compounding you're hoping to see in your portfolio only shows up if you're still standing long enough to feed it, and that takes the same patience and consistency on your side of the screen as it does on the market side. The truth is, the biggest asset in your portfolio for most of your investing life isn't any of these 4 funds. It's your own ability to earn, to learn, and to keep showing up long enough for compounding to actually do its job. So here's the full recap, worth screenshotting. Foundation, VTI or an S&P 500 fund like VOO. Global exposure, a total world fund like VT. Income, a dividend fund like SCHD. Stability, a short-term treasury fund like SGV. And underneath all of it, you, the thing that keeps the whole system funded and running. This isn't complicated on purpose. We didn't touch bonds specifically. We didn't get into sector tilts or small cap value strategies. This is deliberately simple, built to get you started without freezing you under 100 choices you don't need yet. If this helped, let me know in the comments and check the next video where I break down exactly how to split percentages across these based on your age and goals. See you in the next one.